You are staring at a Polymarket board for the June 2026 Brazil presidential election that is actively mispricing, well, one of the most volatile leverage environments in recent history.
Oh, without a doubt. It is completely skewed right now.
Right. We have the incumbent Lula sitting at a dominant 51.5%. You have the embattled right-wing successor Flavio Bolsonaro sliding down to 25.05%.
Yeah, and then you have this insurgent third-party candidate, Renan Santos, who has just suddenly surged to 14.1%.
Exactly. And look, for a casual observer, these are just polling percentages. But for you, the listener trading this on margin, those raw numbers are completely secondary.
Entirely secondary.
Because when you deploy up to 5x leverage on a platform like Predmart, the direction of travel and the velocity of that movement matter infinitely more than the absolute level. Our mission in this deep dive is to map exactly how a margin trader can exploit this chaos.
And there's a lot of chaos to exploit.
There really is. We are pulling from a massive stack of sources today to build this framework. We've got the explosive May 2026 Intercept Brazil audio leaks, plus fresh polling data from Genial Quest, Atlas Intel, and Bloomberg.
It's a goldmine of data.
Okay, let's unpack this. We're looking at a board where a scandal on the right has created massive pricing asymmetry. I mean, if I want this kind of risk-reward profile in traditional equities, I am structuring incredibly complex multi-leg option spreads.
Oh, yeah. You'd be tying up capital in some really messy trades.
Right. So how do binary political catalysts offer an asymmetry that a standard equities options chain simply cannot match?
What's fascinating here is that in prediction markets, your informational edge translates directly into pure price movement. You just don't have the friction you find in traditional finance.
Like, what kind of friction specifically?
Well, you are not battling theta decay, right? Where an option loses value simply because time passes. And you're not waiting for some opaque earnings call where corporate executives might use creative accounting to mask poor performance.
Right. You're not at the mercy of the CFO trying to spin bad numbers.
Exactly. You are trading binary contracts tied to explicitly named events with hard resolution dates. Right now, the scandal engulfing the Bolsonaro camp hasn't just generated bad press.
No, it's way beyond bad press at this point.
It's created a mechanical catalyst that is physically warping the pricing across the entire market board. The right-wing vote is fracturing in real time.
Which sets up some massive opportunities.
Yeah, that fragmentation sets up distinct, actionable trades. Whether you are deploying capital into the heavy frontrunner, trying to capture the violent swings in the volatile middle, or hunting for lottery ticket asymmetry in the deep out-of-the-money tails.
Well, I want to start by looking at the anchor of the board, which is the frontrunner setup. Lula commands 51.5% on Polymarket right now.
And that trajectory is undeniably upward.
It is, and our sources show exactly why. The June 2026 Quatus poll has Lula leading Flavio Bolsonaro 39% to 29% in the first-round scenarios.
That's a massive 10-point gap.
Huge. And it specifically blew wide open after those audio leaks tied Flavio to the jailed banker Daniel Vorcaro. Now, I know the Genial Quest data also models a hypothetical runoff scenario where Lula and Flavio are actually tied 41 to 41.
Right, the runoff is a different story.
But first-round preference is the immediate metric that is driving the prediction market prices right now, isn't it?
Yeah, absolutely. The first-round data is what the algorithms and early momentum traders latch onto. And that creates a highly specific mathematical setup for a leveraged portfolio.
Walk me through that.
Well, we need to break down the actual capital efficiency here, because the mechanics of margin completely rewrite the return profile of a heavy favorite.
Okay, give me an example.
Let's say you hold a Lula contract at 51.5%, and over the next month, it grinds up to 60%. On an unleveraged cash basis, you're looking at roughly a 16.5% gain on your position.
Which, you know, in traditional markets, a 16.5% return in a month is phenomenal.
Oh, it's incredible.
Yeah.
But it's not necessarily life-changing. But you are stepping into Predmart. You are applying 5x leverage.
Right.
So the calculus changes entirely. With 5x leverage, you can control a $5,000 notional position in Lula contracts by putting up only $1,000 in margin capital.
Wait, hold on. I am losing the thread on the capital efficiency here. Let's walk through the actual dollars.
Sure, go ahead.
If Lula's price rises from that 51.5-cent mark to 58 cents, which feels entirely plausible given the momentum from the scandal, that position returns about 12.6% on its notional value.
Correct.
But I didn't put up $5,000. I only put up $1,000. So that $630 profit translates to a 63% return on my deployed margin.
Exactly.
And all of that happens just because an incumbent president extends an already existing polling lead by a few points.
Yeah, that is the raw power of the multiplier effect. And it comes with what we call a structurally bounded downside.
Bounded downside, meaning it's less likely to crash.
Right. When a frontrunner is trading at 51.5%, the contract is exceptionally heavy. It possesses an immense amount of inertia.
It's hard to move the needle down.
Exactly. It is highly unlikely to gap down to zero overnight unless you get a literal black swan event.
Like what?
Well, Lula would have to suddenly declare he isn't running or suffer a catastrophic health emergency. Or we would need to see an unprecedented overnight reversal in voter sentiment that defies all modern polling history. The downside is heavily bounded by the sheer weight of his incumbency.
Yeah, but I have to push back on the strategy of tying up capital here.
Okay, let's hear it.
As a trader trying to maximize yield, is parking a massive chunk of our margin in a 50-cent front-runner contract really the smartest move?
I wouldn't be.
Because even with the 5x leverage, the margin requirement to establish a meaningful position at 50 cents is fundamentally higher than if we were scooping up cheap 2-cent contracts. Aren't we leaving a massive percentage yield on the table by playing it safe with the incumbent?
I mean, that logic makes sense if you're trading a tiny account, but it fundamentally breaks down when you are managing larger margin allocations.
How so?
When you are deploying significant size at 5x leverage, capital preservation isn't just some defensive concept. It is a mathematical necessity to avoid a total portfolio liquidation.
So it's about survival.
Exactly. You are correct that the percentage yield on a cheap contract moving from 2% to 6% is massive. That's a 200% base gain.
Right, which sounds amazing.
It does. But the absolute dollar return on a large leveraged 50-cent contract often outpaces the absolute dollars you pull from those cheap contracts, purely because you can deploy a much larger size without the constant looming threat of a total wipeout. The Lula position basically acts as the keel of a ship. It provides the stability and the ballast that allows your leverage portfolio to survive the turbulence happening everywhere else on the board.
That structural stability makes total sense. Lula is the ballast. But if the left is stable, the middle of the board is an absolute bloodbath for the right wing.
It really is.
And that is where the volatility traders are making their money. Let's look at the disruption catalyst that is causing all of this. In May 2026, The Intercept Brazil published a devastating audio leak.
Yeah, that was a massive shockwave.
They recorded Flavio Bolsonaro negotiating directly with Daniel Vorcaro, who, by the way, is a convicted banker, over 134 million reais in film financing.
Yeah, we are not talking about a standard political gaffe here or a bad debate performance.
Not at all. This is hard, recorded evidence of financial entanglement, and the market reaction was incredibly violent. It instantly triggered a 13-point polling deficit for Flavio.
And, political vacuums never stay empty for long. Prediction markets price that vacuum instantly.
So who stepped in?
The moment Flavio's base began to fracture, Renan Santos from the MBL Mission Party stepped right into the void. Santos capitalized on the Vorcaro scandal by positioning himself as the pristine, clean, conservative alternative.
Which is exactly what a huge chunk of voters were looking for.
Right. He offered a landing zone for voters who desperately want right-wing economic policies but are entirely fatigued by the corruption baggage surrounding the Bolsonaro family name.
And the price action on Polymarket didn't just reflect that shift, it completely amplified it.
It really did.
The numbers on Santos are staggering. We watched his contract move from 4% to 14.1%.
It's a wild swing.
Let's run the exact same margin math we just did for Lula, because this is where the leverage gets dangerous in the best way possible.
Let's do it.
On a pure cash basis, buying at 4 cents and holding to 14.1 cents is a 252% unleveraged return.
Which is already massive.
But if you applied Predmart's 5x leverage to that setup, your $1,000 margin position controls $5,000 in notional value at 4 cents.
Right.
When that contract hits 14.1 cents, you are not cashing out with a nice weekend bonus. That initial $1,000 position balloons into $13,500.
That's unbelievable.
You are looking at over a 1,200% return on your initial margin. Here's where it gets really interesting, though. If we dig into the demographic data from Atlas Intel and Bloomberg.
Yeah, the real-time big data poll.
Exactly. They are showing Santos capturing 26% of the 16 to 24 age cohort. That is the highest share of any candidate in that specific demographic.
Yeah, that's a key data point.
Santos is clearly bypassing traditional television media and algorithmic decay to reach these younger voters. So, as a trader, does this 14.1% price structurally underweight the youth turnout? Is the market essentially offering you a massive discount to buy into the momentum side of this trade?
Well, that specific demographic divergence is the engine driving a beautiful two-sided opportunity. Margin traders absolutely thrive on this exact kind of friction.
The friction between momentum and history.
Exactly. You have the momentum trade on one side and the fade trade on the other.
Break those down for me.
The momentum trade assumes your hypothesis is correct, that the market is structurally lagging behind the demographic reality. If you buy Santos at 14.1%, you are betting that the scandal-driven fragmentation accelerates.
That the youth turnout vastly exceeds historical baseline models.
Right, and that conservative voters continue to permanently bleed away from Flavio. If Santos breaks the 20% barrier under those conditions, your leveraged gains don't just grow, they compound exponentially.
But I'm looking at historical Brazilian electoral trends, and the fade trade feels equally, if not more, compelling to me.
Why do you say that?
Because insurgent third-party candidates almost always pop in the polls early, and then they slowly suffocate as the election gets closer.
Yeah, that is the historical gravity of the two-party system. Shorting Santos at 14.1% relies on the reality that third-party campaigns usually lack the institutional machinery to survive a prolonged election cycle.
They just run out of steam.
Right. The electorate almost always consolidates back around the two main political poles as voting day approaches.
So if the right-wing establishment forcefully reunifies behind Flavio,
Or, if a wild card like Michel Bolsonaro enters the race and successfully reclaims the evangelical base, Santos's 14.1% position could easily wash out and collapse back into the single digits.
just totally evaporate.
Yeah. And the defining advantage of a margin account here is that it gives you the capacity for intense directional conviction either way. You aren't forced to just buy a cheap contract and hope it goes up.
You can get against it.
Exactly. You can actively, aggressively short the anomaly if you believe the historical gravity of consolidation is about to crush the insurgent momentum.
Okay, so if the middle of the board is about catching the right-wing fracture, then the absolute bottom of the board is about catching the runoff from that chaos.
The extreme tails.
Right. If a trader wants maximum asymmetry per dollar deployed, we have to look below the 3% threshold. We are talking about deep, out-of-the-money asymmetry.
We are looking at contracts priced between 0.75% and 2.15%. And let's be explicitly clear here, these are not high probability positions.
Yeah. No, not at all.
The vast majority of these will expire completely worthless. But the leverage mathematics down in this basement are so extreme that they completely alter how you construct a risk portfolio.
Let's run through these cheap contracts, because the sources highlight some wild institutional setups. First, you have Ronaldo Caiado sitting at 2.15%.
The governor of Goiás.
Right. And unlike a typical fringe candidate, he has massive institutional backing from the PSD party and its leader, Gilberto Kassab. He secured the party nomination over two other sitting governors.
Which means this is a real political machine, not just some vanity project.
Exactly. If the center-right decides the Bolsonaro family is completely toxic and they consolidate around an established executive, Caiado absorbs that entire machine.
And the math on that is wild.
It is. A move from 2.15% to 6% on an unleveraged basis is roughly 180%, but at 5x leverage, that is a 900% return.
Wow.
Then on the other side of the aisle, you have the left-wing hedge, Camilo Santana, at 1.75%.
Yeah, Santana is a phenomenal mechanical hedge. He's the current education minister, and he recently received the June 2026 Paulo Freire Medal in Fortaleza.
Which is a big deal locally.
Huge. That medal isn't just an award. It operates as a massive signaling mechanism for the political left in the Northeast region. In fact, we recently saw his Polymarket price jump from 1% to 4%, purely on minor news flow regarding his regional visibility.
Just off minor news.
Yeah, that proves how incredibly sensitive these illiquid tail-end contracts are to any incoming volume.
So what's the actual thesis for holding him?
If Lula faces a sudden health issue or unexpectedly declines to run, Santana is structurally positioned as the natural succession candidate for the PT party.
Makes sense as a leak-wing hedge. Then you have what I like to call the family arbitrage play.
Oh, this is a fun one.
Michel Bolsonaro is trading at 1.35%. Some of our polling sources actually show her matching Flavio's numbers in specific head-to-head scenarios.
Yeah, which is fascinating.
The implication is that the evangelical base might be perfectly happy to swap out the scandal-damaged son for the politically untarnished stepmother.
And a margin trader could construct a brilliant hedge right here.
Right. You go long Michelle and you short Flavio. If you do that, you capture the value if the base forcefully swaps them out, and it doesn't even matter if the broader right-wing coalition actually wins the general election.
Exactly, you are just trading the internal family dynamics.
And finally, we have the ultimate lottery ticket, Jair Bolsonaro at 0.75%.
Yeah, trading GR at under penny is purely pricing in judicial volatility. It is a known fact that he is currently legally ineligible to run due to a Supreme Electoral Court rule. But in December 2025, he endorsed Flavio from a hospital bed. And that single act proved his absolute continued influence over the base.
So it's a legal gamble.
Right. At less than a penny, you are pricing in a microscopic probability of a court reversal. But if the legal system unexpectedly reverses that ineligibility, you are looking at an instant 20x repricing of the contract before the market even fully processes the headline.
Okay, I have to inject some sanity here and challenge the actual trading reality of these positions.
Fair enough.
I look at these sub 3% contracts and they remind me of deep out-of-the-money equity options, one positive headline, and they explode. But in binary prediction markets, going to zero is a near certainty for almost all of these tail-end candidates.
That's the reality of the asset class.
So if I'm deploying 5x leverage, how strictly must I size these positions? Because if I get wiped out on Caiado or Santana, I cannot let that cascade into a brutal margin call that liquidates my Lula anchor position. How do you actually manage this without blowing up your account?
If we connect this to the bigger picture, survival in margin trading comes down to ruthless mechanical position sizing. The mathematics of leverage are incredibly seductive.
They really are.
I mean, a contract going from 1.5% to 4.5% delivers a 1,000% return when you apply the 5x multiplier.
Yeah.
But you're entirely correct. The downside is absolute.
Total loss.
Yeah. If a candidate fails to register, drops out, or misses a deadline, that contract instantly resolves to zero. To survive this environment, you must construct structural bulkheads in your portfolio.
Like compartments on a ship.
Exactly. You should be allocating absolutely no more than 5% to 10% of your total margin capital to these sub 3% contracts combined.
Just 5 to 10% total.
That specific rigid sizing preserves your exposure to that massive 1,000% leveraged upside, but it fundamentally contains the damage. It acts just like bulkheads on a submarine.
So if they drop out.
If multiple tail-end candidates drop out simultaneously and those compartments flood, you take a managed hit. But the rest of the ship your anchor positions survives to trade the rest of the board.
Okay, so we know what assets to target. We have the bounded frontrunner in Lula, the volatile momentum trades in the middle with Flavio and Santos, and the deep out-of-the-money asymmetry at the bottom.
We have the whole board mapped.
But knowing what to trade is useless if you don't know when to execute. Time is leverage. If you don't perfectly time the Brazilian electoral timeline, you will just bleed out in margin carrying costs or get caught completely off guard by a locked market.
Timing is everything here.
These are dated mechanical catalysts. Let's walk through the execution calendar.
The calendar dictates every single price movement from here on out. From July 20 to August 5, you have the official party conventions.
Okay.
This is the legal mechanism for building coalitions and formalizing tickets. For a leverage trader, the window immediately before those conventions close is your final opportunity to position for coalition surprises.
So get in early.
Yes. If you build your position before July 20, you capture the volatility premium. If you wait until after August 5, the market has already digested the news and you are paying a massive post-news premium to enter the trade.
And then we hit the absolute brick wall, August 15 at 7:00 p.m. Brasilia time. This is the TSE, the Electoral Court Candidate Registration Deadline.
A critical moment.
I cannot stress this enough. This isn't some soft political deadline where candidates can negotiate an extension. It is a hard mechanical timestamp. Unregistered candidates instantly go to zero.
No exceptions.
The market will mercilessly reprice the entire board the second that clock strikes 7. It's like a game of high-stakes musical chairs. But because of the 5x margin, the music is playing at 500% speed.
That's a great way to put it.
If you are still holding a tail risk candidate when that 7:00 p.m. registration buzzer hits, the chair isn't just pulled out from under you, your entire portfolio falls through the floor. You must be fully positioned or safely exited by August 14.
That is exactly right. And the environment changes drastically the very next day. August 16th marks the legal beginning of the official campaign period.
What does that change for the market?
Well, that means television ads, radio spots, and massive street rallies are legally permitted. Historically, this transitions the prediction market from a phase of pre-campaign insider maneuvering into a phase of direct volatile voter contact.
There's a lot more noise.
A lot more volatility. It is highly likely that market makers on platforms like Predmart will proactively tighten their margin requirements during this phase to adjust for the elevated, unpredictable price movement.
That's a huge factor to watch.
Definitely. Then, as we move into September and October, you have the live television debates.
And we know from our data sources that Brazilian TV debates can swing polls by 5 to 10 points overnight.
Oh, easily.
If you are leveraged 5x on a candidate who completely freezes on stage or gets destroyed by a rival, you are going to feel that in your account balance the minute the market opens the next morning.
Instantly.
Then we hit October 4, which is the first round election. The contracts of eliminated candidates mechanically go to zero, and the surviving runoff candidates see their prices spike as the field violently narrows.
The final consolidation.
Right. Finally, October 25 is the second round runoff, the final binary resolution of the entire market. So what does this all mean?
It means you have to respect the calendar.
Exactly. It means the August 15th 7:00 p.m. deadline is a cliff edge for pricing. If you get caught holding Santos or Caiado on August 15th and they haven't filed their paperwork, your margin account doesn't just take a hit, it gets obliterated.
It underscores a fundamental reality. Prediction markets, unlike traditional equities, are entirely governed by these hard timestamps.
The clock is literally ticking.
Yeah. The most successful leverage traders aren't waiting to react to the news after the fact. They are actively managing their 5x margin positions on Predmart well before these calendar dates hit. You have to trade the structural calendar with the exact same discipline that you trade the candidates themselves.
Let's pull this all together. Trading the June 2026 Brazil presidential election on margin gives you three highly distinct lanes of operation. You have bounded momentum with Lula, where you can deploy larger capital efficiently because the downside is anchored by his incumbency.
Right.
You have extreme volatility in the middle of the board with Flavio and Santos, entirely driven by the fallout of the Vorcaro financial scandal and shifting youth demographics that are bypassing traditional media.
The momentum lane.
Exactly. And you have deep, out-of-the-money asymmetry with Caiado, Santana, Michel, and Jair, where strict 5 to 10% sizing discipline can yield 1,000% returns without sinking the ship. And all of this is mapped against a merciless 3-month catalyst calendar.
It's an incredible setup for anyone who understands how the mechanisms of 5x leverage actually function.
Truly unprecedented.
This raises an important question, though. We know exactly how to trade the dates, August 15th, October 4, October 25. But in an environment this politically fractured, what happens to a highly leveraged portfolio if a systemic legal challenge delays the TSE calendar itself? Yeah. If time is literally money in margin trading, how does a trader hedge against the sheer duration of the trade changing at the very last minute?